Hi, everyone. I hope you all can hear me now. So, welcome to this live stream. First of all, I would like to apologize for my voice. This weekend my brother got married, so I kind of lost a little bit of my voice. Um, just a second. I'm being told I'm not. You cannot hear me. Just a second. Okay, great. Now I get the confirmation that you can hear me. Great. Okay, so again, welcome to this live stream. It's titled Zero to Fund It. Basically, I will explain you what will be your journey, your fundraising journey, from the initial step up to the last step. Before I begin with everything, I'd like to apologize for my voice. I've lost some of it because this weekend, my brother got married, and too much singing and all the joy and fun kind of took a little bit of my voice. So moving along, so this is an event that was asked by the SA community, the Dream Activitete community. It's an Albanian community. Alkeo Hoxha from that community reached out, and together with Lily Dora, who runs the this community, we agreed to do this this event in the form of a live stream. So we could help their community, but as well as others out there, who want to see this live or will basically go watch the recording later on. And so, before I start with the fundraising journey, a little bit about me. I'm Chef. I'm an angel investor. I've been doing this for the last 4 years, angel investing, advising, and mentoring. I have done so far 14 investments. I had one exit, and a few others are loading up. So this is where I'm at. But before that, my foundation is in tech. I was a software engineer for over 13 years, serial founder, founded multiple ventures, some small exits, one meaningful exit. And so, yeah, and like I said, last 4 years I've moved to just doing angel investing. Then that's where I'm at. So getting started with the whole fundraising journey, it will start with you basically researching the investors that you want to reach out to. And in particular, you want to research and find out if those investors are aligned or invest in the kind of venture that you have, in the kind of startup that you have. That's where it all starts. And basically, you are looking for their investment thesis. Some investors will list their investment thesis, some will not. I personally do list it, and a few others as well, but most will not list it. Now, depending on the stage of your startup, where you are at when you begin fundraising, you could be pre-seed, seed, or later on Series A and so on. But I will keep this focus a little bit more for the entry levels, like for the angel stages, pre-seed and seed, because once you are Series A and later, you kind of have done it, and you have an idea of what the journey is going to be, because it's kind of a repeat cycle, basically. So in the pre-seed and the seed stage, my suggestion is you focus with friends and family and angel investors, because the VC funds, now there are some VC funds that have arms for investing in angel stages in pre-seed and seed, but generally VC funds would jump on board Series A and later, which means that they would be you would have basically found a product market fit because they have a different business model compared to angel investors. In a way, angel investors, the difference, basically, the core difference between angel investors and VC funds is that angel investors invest their own money, whereas VC funds invest their investors' money, their LPs, limited partners' money. And so, the way we look at things is a little bit different. And as an angel investor, I would invest in a company for a longer, and be with the company for a longer term versus a VC fund. A VC fund will come in, and of course they will be able to give you much more money than an angel investor could give you, but they want you to spend that money, and so you either become a success or a statistic. And so the whole approach should be that they are great. VC funds are great, but there is a time for them. You should not approach VC funds on the angel stages, pre-seed and seed. So basically in those early stages, look for angel investors, and of course the sizes of angel investors are smaller compared to VC funds, so you were going to need more angel investors. But the suggestion is that you look for angel investors who could help you with more than just the capital. Probably they can make connections, or they have some expertise that can help you on with and so on and so forth. So look for that extra in that partnership. And some investors are hands-on, and they take an active role. I am also personally an active investor. I prefer to contribute my expertise apart from my capital as well. So I want to help raise the value of the company through my expertise. And so now, going back to where I started, that you have to research. And so when you do this research, depending on the stage you read, focus on the kind of investor that you want to attract. If you want to attract angels, so focus on angel investors. If you want to attract VC funds, you're going to focus on those. But for both of these types of investors, and there are also other types of investors like corporate VC funds and so on and so forth, but I'll not touch more on that. But for now, let's keep them, in the same group as just VC funds. So it doesn't matter who you're going after. Whoever you want to bring on board as an investor, you have to follow the same process, and that is finding out if there is an alignment between your venture and their investment thesis. Basically, if it's an angel investor, it's their personal investment thesis. If it's a VC fund, the fund thesis, and so on and so forth. So make sure that if the thesis is published, that will be great for you. You will know right away if you are in alignment, let's say in geography or sectors or whatever they're looking for. If it's not published, there is a way that you can guess if there is an alignment or not. And that is by looking at their portfolio companies. See if they have invested in companies that are in the same sector your venture is in, or same region, or if your venture would actually be complementary to what they have in their portfolio. If there is some portfolio company that would be a great synergy partner for your venture, that might also be an alignment for them. So basically try to reverse understand their investment thesis by going through their portfolio companies. Now, there's one caveat here. There's one pitfall here that you should be careful. If they have a portfolio company that does exactly what you're doing, do not reach out for an investment. Do not approach them. Do not share anything with them, because there is a high chance that they will not invest. and they may help their portfolio company with what you're giving them. Of course, it's not going to be, it's going to be under the table most of the time, but the suggestion is do not reach out to them if a portfolio company that they have is a direct competitor to you, or they're doing exact same thing that you're doing. So stay away from those investors in that case. Now, once you found out that there is an alignment with their investment thesis and your venture, then you have to basically reach out to them. And the reach out can be, via email or via LinkedIn or whatever other means that you can find to reach out to them. Now, in this initial reach out, there is a kind of a structure of the message that you have to follow to make sure that your outreach will be as effective as it can be. So after the greeting, the first few lines should be you explaining to the investor how do you believe that your venture is aligned with their investment thesis. This should be clear to them. Like, for example, I invest in fintech, adtech, and health tech. If you were going to reach out to me and you have something in fintech, you'd say, I saw that I saw on your LinkedIn profile investment thesis that you invest in fintech based in US for B2B. And so our venture is a fintech based in US and offers services for B2B and whatever. So make sure you mention the alignment in the first few lines. That will help the investor kind of see the match right away, because that's what we're doing. When we receive these messages, the first thing we're doing is we're kind of glancing through the whole message to filter out those deals that are not aligned with our investment thesis. And so you want to make sure that you make it clear to them that there is an alignment, and this is the reason why there is an alignment. If you find the alignment through the portfolio companies, you mentioned that you saw that they invested in XYZ portfolio company, which is in this sector and based in this region or whatever. So make it clear to them in those first few lines. Once you have made that clear in the message, then the next part should be the venture highlights. Basically, what you are, like fintech, B2B based in UK, and then traction. Whatever you have got to raise that interest, but it should be in a form of plain and simple facts. 1, 2, 3, boom, 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 boom. Do not write long sentences or paragraphs in this highlight part of the message. The highlight comes right after the alignment declaration, and the highlights should be basically just simple facts: where you're at, how much revenue have generated so far, or if you haven't, whatever you have got in terms of facts that would raise the interest for investors. That's what you list there after the alignment line. So after you list the highlights, then you go a short description of what's the problem you're trying to solve and what's your solution. Again, short, keep them short. Don't go extended long messages. Investors will not read them, and there's a high chance that they will see a long message and their head starts hurting and they will just ignore your message. So don't go that long format. Just give it to the point, direct. So problem, solution, and then traction. Now here it's not like the highlights. You have to kind of describe shortly what's your traction so far and why you believe things are at a point where an investment would be great, because there would be so and so on will happen. Let's say you have an interest from a client or whatever you've got in terms of traction. You mention it here, And then the last part of the message should be the call to action. And basically here, the whole purpose is to ask for a pitch. You want to schedule a pitch with the investor. So that's basically the structure of the message you send out. Greeting, the alignment, venture highlights, the problem, solution, traction, and call to action. And the call to action should, you could ask them for their calendar link or for a few time slots that they have available, but you should also have a calendar link, and you just basically tell them, if it's easier for you, use my calendar link, here it is. And so that's the whole purpose. Once you you have sent that message, and hopefully they will like what you have got, and they will agree to schedule a meeting with you. So then you go on and pitch to the investor. Now it could be, it could be one-on-one pitch, or sometimes maybe later on stages, you're going to pitch to angel networks, and I'm part of some angel networks. And so when you're pitching to angel networks, it's a kind of a different style versus when you're pitching one-on-one. Generally, you're going to have a bit less time with when you're pitching to a group, whereas when you're pitching to one-on-one, you might have more time, and you might have lots of back and forth with questions and stuff like that. So, but basically, you're going to go on that pitch, and you will pitch your venture. Do not start doing small talk with investors. Do not start wasting time once you are on that pitching meeting. Try to, after you have those greetings, try to go through your pitch, because you don't know yet if you're going to work with this investor, and the investor doesn't know if they're going to work with you. So there's no reason for you to go on in sharing deeper details, and investors have very limited time, and so they will kind of get agitated a little bit if you start going sideways from what the whole purpose of the meeting is. So try to stay focused on what's the purpose of the meeting, and that's pitching. So bring up the pitch deck and start pitching. Make sure your pitch deck is in the right format, and there's a whole structure of what the pitch deck should be, and what you should include and shouldn't include, and so on and so forth. So I have actually a pitch deck playbook. I run a Telegram group for founders. So if you want to get, and it's I run it for free basically. And in that Telegram group, I have lots of tools and resources to help founders. And one of those resources is the pitch deck playbook. And so if you want to grab that, just DM me on LinkedIn and ask me for the pitch deck playbook, and I will send you the Telegram group link, and then you can go and grab it from there. And basically follow a template that has worked before, and it's kind of what investors expect. Don't start putting lots of text in your pitch deck or whatever, or making the structure of the pitch deck such that the investor will have a hard time following you. There is a way of how things should be that the investors expect them to be, and so you try to keep it that way. Otherwise, you're going to lose their attention. So have in mind that the whole purpose of the pitch deck and the pitch is not to convince the investor to invest right then and there. It is not. It is to convince the investor to set a following meeting, or to set a if you're going to have a tech product, a demo meeting, or they will ask for more stuff from you. So do not push it up to the point like asking the investors to give you an answer if they want to invest or not. That is not the purpose. That is not what you should be doing. The whole purpose of the pitch and the pitch deck is to raise the interest, so the investor will ask more and wants to see more of what we have got, to understand this opportunity better, and be able to make the decision if they want to jump on board as an investor or not. So do not push them for that. Like, if I can give you an example, it's like if you're gonna go out on a date for the first time, you don't ask the other person if they want to marry you. You want to ask them if they want to come out again, go out again on the second date, and so on and so forth. It's exactly the same thing with investors. You basically raise the interest, so they want to find out more, or they want to have a demo of the product, or they want to have a follow meeting if they have other co-investors, or if they have like if you're going to pitch to VC funds, they may have other partners that they want to bring on board, or people from their team, basically in follow-up meetings. And the follow-up meetings would generally be more deep diving and more in the style of a due diligence, compared to just the pitching, which would be just that raising interest part. Now, once you have completed the pitch, and as I said, whole call to action of the pitch should be to set a demo meeting, or set a follow-on meeting, or if the investor is asking you for more, you could tell them that they can find more about the opportunity in the data room. And so now we will go to the next step. What is the data room? And how it helps investors make their decisions. So the data room is basically a structured folder which holds documents and information about the venture. It's a complete set. And what you include in it, for this, I also have a playbook, a data room playbook, which you can grab again from the same Telegram group for founders that are run. So DM me on LinkedIn for that link, and I will send it over to you. And basically, it will be very helpful. So depending on the stage where your company is at, pre-seed, seed, or Series A, and so on, it will tell you what you need to put in this data room, basically. And so after the pitch, basically, if the investor have some interest and want to explore more your venture, you will give access to your data room if they ask for it. And the data room, so for the data room, if you have sensitive stuff in there, like IP or stuff you want to protect, you can ask for an NDA, a non-disclosure agreement, but only for the data room, not for the pitch, not for the pitch deck, not for anything before this stage. For the data room, yes, you can ask for an NDA if you have sensitive stuff in there. If you don't, then there's no reason to ask for an NDA. Now, some investors may hesitate to sign the NDA, and if they do, then what you could do is create a lighter version of the data room, which would include only those stuff that are not sensitive, that you don't want to highly protect. And so you give access only to that data room, basically. So the whole point here is you give access to them in this structured storage folder, and they go on through it on their own and understand more about what you're doing, and what your advantages are, what's your mode and stuff, whatever. They want to basically do their own full due diligence on this, about the product, the team, and everything in between. So that's the step. Now, the other part would be once they have done their due diligence and they're happy about now they may ask for follow-on meetings even after they have had access to the data room, and so basically you would go on for those follow-on meetings up to a point where they reach the decision to invest or not. If they do decide to invest, then the next step would be to sign the investment agreements. And there are different ways you can accept investments from investors, but in the angel stages, in the regions where I invest in UK and US, generally you would use a safe. The safe agreement is basically used for angel stages where and the safe agreement, so angel stage basically precedes seed again. So for those who don't know what angel stages mean, so for the safe agreement, if you do not, so if you sign only the safe agreement, you're okay. There is not much risk with that. It's a standard agreement. Now sometimes investors will ask for what's called a side letter where they spell out other rights. Now, some of those rights would not be big of an issue for you, but there can be rights in that side letter that might be an issue for the founder, and so you have to consult your your attorneys, your lawyers for that, and your get legal counseling basically, so you understand what those rights are, and if they're good for you or not, and if they're not, what would be, what would be the issue for you down the road. Basically, be be aware of what they're bringing up for you on that side letter, and so then basically, they'll sign those agreements, the safe, or later on if you're going to do a bridge or if you're going to do equity rounds and so on. So you could use also convertible notes, and what these agreements are, you can go on and research online or go through my LinkedIn posts. I have shared a ton about them. I have also a series there. It's called Founders Fails and Fixes series, where I go a little bit in detail on what you should watch out for, what are some of the pitfalls that you should be careful to not step in. So it's either going to be a safe, a convertible note, and later on it's going to be direct equity. So whatever agreement you're going to use, they're going to have to basically sign those agreements. Now, do not forget to make sure that the investor is accredited. And there are different, so for different countries, there are different requirements and different definitions in the law. But for US and UK, we're investing. For US is an accredited investor. For UK, it's a sophisticated investor. Now, and that basically means that an investor has to have either for US has to have either a net worth of 1 million and over, excluding their residential property, or they have been generating over 250,000 US dollars for the last 3 years. That's how they would qualify to be an accredited investor. Now, that's if the investment is coming from an individual. If the investment is coming from an entity, you must make sure that, again, they fulfill the requirement. And the requirement for the entity is that they must have at least 5 million in assets under management, or all the owners of that entity must be accredited investors. So if they are, all the owners are accredited investors, they don't have to have at least 5 million in assets under management. They could have less. But as long as that requirement is fulfilled, that all the owners are accredited investors, then they can make the investment. Make sure you check this if the entity is registered in US and UK. I know the requirements. I don't know about other countries. Make sure you check this for the country where your venture is based in before you take money from the investor. And actually, you should have an idea if the investor is accredited or not from the beginning. When you start approaching them, do not approach somebody that you believe is not an accredited investor, because there are going to be issues down the road. And so there are two main risks here when they sign the agreement and you get their money, if you don't make sure that they are an accredited investor. And basically the way to make sure about that is you will give them a form. There's the standard form or like standard terms that you can put on a form where they self-certify. They say that they are accredited or not accredited. And so if they say they're accredited, then you will be able to take their investment. But if you know for sure that they do not fulfill the accreditation requirement, do not move along with them. Even if they say that they're accredited, but you know for sure they're not accredited, or you believe so, do not move forward with them. Ask to verify their accreditation status. Now, there are services that can help you with that, or you can do that on your own by basically, asking for their proof, like financial means that they can provide us proof of their accreditation status fulfillment. So I want to stress this out again, make sure that the investor is accredited before you get their investment, because there are two things that can happen down the road if you did not make sure and that they are not accredited investors. One is, the SEC could find out at some point that you did accept an investment from a non-accredited investor, and they will basically do a forced rescission. They will, as a first step, they will force you to give back the money that you got from the investor. And your venture might be at some point where you're going to need that money badly, or you don't have the money or whatever. So they will basically put you in default. The other thing that they will do, they will impose penalties. Things could go up to criminal level. So do not miss the step of checking the accreditation status before you get the investment from the investor. It's really critical to make sure that they're an accredited investor. Now, once you have made sure of all of those, meaning that they certify they're accredited, you know that, and you believe that they're accredited, and they sign the agreement. The investment agreement could be safe, convertible note, or equity, whatever it's going to be, subscription in UK. So whatever it's going to be, you have those agreements signed, then they will have to basically send you the check or the wire or the bank transfer and so on and so forth. So, excuse me. So be careful to do not consider it a complete investment unless and until the money has arrived on your bank account. It's not a complete investment before that. I've seen, I've had a chance to know of a funder who believed that the investment was final, They trusted the investors would go forward with the agreements that they signed, uh, and they went out and got a loan while they were waiting for that money to come in. And the loan that they got, they put it in the company, and then the investor basically withdraw their agreement. Now there are ways to go after them, but with what capital are you going to go after them? So the whole point is, do not go out and spend money that you don't have yet in the bank account, with the assumption that once the investors sign the agreements, the money is final. No, it's not. It's only final once it arrives on the bank, and even then, there might be issues if you have lied to the investor, if you had, basically there are ways that even at that point they may have a chance to get back the money from you, but that's a different point of discussion. But so far, so this is the whole journey. Basically, you research their investment thesis. If you believe they're in alignment, you reach out to them, and in that there's a format of the message that you send to them, and then once they agree to have a pitch, you're going to give the pitch to them in the pitch meeting, and then they may want to ask for follow-on meetings, like a demo of the product, or go on and have a deeper dive, a due diligence process in follow-on meetings. And they may also ask for your data room after that first pitch session that you had with them, so you will give access to that data room to them, and they will do their own due diligence. Once they make the decision to invest, they sign the investment agreements, and then they wire the money. Now, it's, again, I want to stress out that make sure you verify that the investor is accredited before you get their money. It's really important to make sure that you confirm that. Now, throughout this whole process, the key to success is following up. It's absolutely critical that you follow up. That's the only way you're going to be successful in fundraising. And the following up should be in the form of, like, for example, you send them the message a week ago or so, and you're going to follow up with them. But when you follow up with them, you want to repeat your ask for the last time, but you will also include some value, some extra value, in terms of, let's say, if you had some traction from last time you talked with them, you're going to mention that in that reaching out, in their follow-up. You're going to say to them, here's what happened since last time we talked. And so basically list those those things that you believe they would find valuable in their decision-making process, if they want to be on board with you as an investor or not. And so that's basically the secret to this whole process, following up. Also, there's a secret here that if you're going to have investors that are going to say that they don't want to invest in this opportunity, do not start arguing with them, because you're going to burn the bridges that might be important down the road. Do not argue. Do not just thank them for taking the time to review, and that's how you're going to leave a good impression on the investors. And before you disengage, ask them one thing that's important, is ask them if they would mind if you kept them in the loop with with updates from your venture. So and some will basically not like that, but some would maybe like that in case they made a wrong decision and might want to jump on board with you down the road. So if they agree to receive those those updates, then you will basically keep them updated of about stuff that has been happening in your company. Let's say every 1 month or 2 months, you will send out an update to these investors about the what's been happening with your venture. And in case one of those investors wants to wants to jump back in and take a bite at whatever you're raising at that point. Now, this is basically the whole journey of fundraising. So that's basically what I had to give to you all for this live stream. Now, I will look in the chat and see if there are questions that have been asked. But before I do that, I want to bring up the QR code for the link tree of SA community, the Suggerim Activitatea community, which is the Albanian community here, and they have a subgroup for startups. So feel free to scan that QR code and go through their all their communities, and if there's something you like, feel free to join them. Again, this is for Albanians, my fellow Albanians, because these communities are in Albanian, so it would make sense for others to they wouldn't get any benefit outside of Albanian community. So that's one thing I wanted to share. Now, the other thing, the other QR code I want to bring up is my LinkedIn profile. If you're watching this from another platform other than LinkedIn, or if you're watching this from LinkedIn, feel free to directly connect with me. I'm open to connecting with everybody, and I will try to help you best I can. Especially if you are my fellow Albanian, I will try to help you even if I don't invest. Reach out to me, any question you have, any obstacle you're facing. I would try to do my best to help you all, all founders basically, but especially my fellow Albanians. So do not hesitate to connect with me. Scan that QR code and connect with me. Now let me go through the questions in the chat and see if there is something that I would like to answer. So, okay, if you have, okay, now we have this question from Max. What if I had an angel investor and everything went well and they were interested to invest, but they were not a credit investor? What happens here? Max, no, you don't want to get their investment. That's unfortunately, whatever amount of time you have spent with them will basically be thrown out the window, because it doesn't matter what they have agreed to. If they're not an accredited investor, do not get their investment, because there is a high risk that you're gonna that investment will get rescinded if the word gets out to SEC, if your venture is based in US. Do not get their investment. This is my strong advice. Make sure that they're an accredited investor. So I don't know if anybody else has any other question. Please type it in the chat, and I'll try to answer it now. But it looks like we don't have any other question for now. I will just stay on for a few more minutes in case somebody's typing something up. So for all the things that I touched on, basically these documents and these agreements and stuff, I have shared a ton in my LinkedIn. So I suggest everybody goes through my posts, and you will have lots of value there to help you out, especially if you're doing this for the first time as a founder. So make sure you go through them and get educated, basically. So let's see, I have a question here. So Gentian is asking, everybody's reaping, but no one is sowing. What is the point of angel investment if the startup environment is not fertile? I don't know what exactly you mean by that, but I mean there are tons of startups that are coming up, and there are tons of startups that are raising funds. Of course, it's not as easy it used to be after the COVID era, but and that's probably also because not that many exits have happened, and so lots of capital is locked up in these ventures, and something has to be done. They either go public through an IPO, or they get acquired by a bigger company, and so on and so forth, and those profits will be realized, and then investors will get back some of that capital, and they will be able to reinvest it to another venture. But the whole, yeah, I mean, or maybe through tokenization down the road, probably that capital might be, might have another path to be unlocked, so it can be reinvested in other ventures. But so yeah, I don't know if you want to specify more on what exactly you were asking, but that's the answer I had for that. So if anybody else has any other question, feel free. So let me see if there's any one more. Okay. Yeah, so it looks like no one else has any other question. So I'm gonna end this live stream here. Again, sorry for my voice. Elio asked the question. Where is the question, Max? I don't see the question. I don't see any question. Can you, Max, write that question, because it's not showing up for me here for some reason. Okay. So while they bring it up, I believe I have another question here, or it's just a. So let's see, Dania. So angel investors are the best type of investors in our experience. We're grateful for each one we have on board. The question is how to find others. Angel groups have not been great in our experience. They tend to be risk averse and bureaucratic. Yes, Dania, that's, I mean, for angel groups, that's kind of true, and angel groups do tend to invest in later stages once the venture has been de-risked a little bit. Now, where you're going to find these other angel investors is going to be probably through warm interest. And my suggestion is to always ask the investors that have invested in your venture for introductions Do not ask for investors that have decided not to invest in your venture for introductions, because it will basically spook out these other investors, and then you'd have to do much more work to convince them, on, to explain it to them why these investors that did the intro didn't invest in your venture in the first place. So ask for warm interest from your investors, that the investors have already invested. There are other like ways you can find, like there are platforms as well. One of those is openvc.app, where you can find these investors. But there are others as well, like OpenVC, so where they have this list of angel investors, and the real critical point is you have to find out if the investors' interests are aligned with your venture, basically. That's the point. Do not reach out to investors that are not aligned with your venture, because they're not. You're going to lose time, and they're not going to be interested either way. So that's that. So the way to find those investors, that's what I would do. I would look for warm interest from investors. I would look in for these platforms that have lists of investors that have made themselves available to founders to reach them out. And there are also like cold lists, but that's I wouldn't go out and send an email to a cold list. That would not work out that well. I would rather go and try to connect with them in LinkedIn. And so there's a strategy that I've used before, and I recommend to to even for sales, but also for investors. Before you send out that connect request, warm up this connection, basically. And that means that try to engage with them in some form, like commenting on their posts, or liking their posts, or trying to give them some value before you send that connect request, and also see if there is somebody that they have as a connection, and you might know. Ask them if they would be willing to do that introduction for you, or if they can help you understand a bit more about this investor, talk a little bit about the investor, and ask them if they would mind if you name drop them on that connect personalization message. And if they don't mind, then you would basically be more effective by name dropping that. I was talking with Chef about you, and Chef told me that you invest in fintech, and our venture is a fintech, and we'd love to connect and see if there is if there's any interest from your end. And so basically try to name drop, and if you have engaged with them also before, liking, commenting them, I have noticed your name, so it will be more effective when you reach out to them that way. So yeah, that's the strategy I would recommend when you connect with them on LinkedIn. Now, let me go to this other question from Elio. So Elio is asking, during the seed phase, is an MVP enough, or would it be necessary to already have customers? You need to have traction for the seed phase. So the pre-seed is where you basically do some work to validate your startup idea, and then you build the MVP during the pre-seed, and then you have those first pilot users come on board, and then you fix the MVP and you keep on working on it. Whereas during the seed phase, you should have some real traction going on. Of course, it's not yet product market fit, and the end goal of the seed, meaning that the end result, what you're going to reach at the end of the seed stage would be product market fit, and that would move you to Series A. So during the seed phase, you you should have traction. It's not going to be only the MVP that will cut it. You have to have some traction. So yeah, that's where that's what you need. Thank you for the question, Elio. Now I believe there is another one, maybe from Dana, from Noel. Yeah, thank you. So let me bring that up. So Noel is asking, how do you deal with a venture capitalist who meets with you and after you have shared some borderline important technical information, reveals at the end of the meeting that they are speaking with another company, different technology, but working to solve the same problem? Yeah, I would, like I suggested, before you reveal the important technical information, the sensitive stuff, have that NDA in place just in case, it will help a little bit deter them from sharing information that they got from you. It's not 100% guaranteed deterrent, but it will, make them think twice at least. So have that in mind. But there isn't much you can do about that. If they want to go with another company, the only thing I would do is try to understand what they like about this other company, what's better for them in this other company, and if there is something real differentiator, and it's the perceived value that the investor has is actually the real value that this company has, and that's a differentiator from what you're offering. So it's open business. It's open market. They will go wherever they like to go. So the only thing I want to try to do is try to understand if their perceived value is actually the real value that this other company is offering. And if it's not, then I'll try to help them understand where things stand. So they basically make their own decision on the right facts and not comparing apples to oranges and stuff like that. So yeah, that's what I have for that. Let's see, from Alkeo here we have a question. How to judge the exact value of startup shares in Albania without a stock exchange? The value of the startups is not generally determined by the stock exchange. It's mostly determined by some factors. One of those being what's the team behind it, what's the product they're building, what's the market size they're going after, and what's their traction, how far along they've got, if they've got any revenue coming in, and then it's going to be a multiple of the revenue, and also try to see if there are similar startups that are in the similar sector, and see what their valuation was at the stage that you are at, and try to do that comparison. But it will be a back and forth thing with investors, especially with the lead investor. It's not going to be a finalized number. It's negotiation basically, and you will bring up these factors, that this is the team, because of the team, this is the value, this is the product, and then because of that, this is the traction, and because of that, we've got this, and so on and so forth. So basically, try to have a well-rounded calculation of all those factors when you determine the valuation of the venture at the stage you're at. Okay, now let's see if there's anyone else here. So I don't see, yeah, I don't see any other question. Again, thank you everybody for the questions, and thank you, Alkeo Hoja, for for inviting me to do this for your community, and Lily Doda also for the invitation and giving me the platform on your community. I'm happy to do this for you anytime, and for anyone else who wants to help founders. Basically, I'm available for that. Thanks for everyone who tuned in. If you want to have access to those resources that I talked about, and reach out to me, connect with me on LinkedIn, and I would send you my Telegram group link, and then in there you're going to find these two important resources that I talked about, the pitch deck playbook and the data room playbook. But there are other great resources in there, as well as many other fellow founders who help each other. And I also make myself available for questions, and I answer when I can, whatever question you might have down the road. So let's get connected, and until the next one, I wish you all the best, and I thank you again for tuning in. Let's stay tuned for the next one.